Hello again, this is Harjinder, and we are looking at practice question number 2 from topic 4, investments in associates. This question covers quite a few things here. You have this company initially acquiring 8,000 shares, accounting for the investment under the fair value profit and loss model. And then subsequently next year bought another 16,000 shares, and thus gaining significant influence. So you have the flavor of fair value profit or loss first, then you have a change in the accounting model once significant influence is obtained. So you have to remember to remeasure the existing shares when significant influence is obtained. And then after March 1st, the equity method will be used to report the investment. We also have fair value differences in play. There are no there was an intercompany sale of land during the year. There's dividends. So this is a pretty interesting question, and I'm sure it will help check off a lot of boxes from the topic 3 that dealt with fair value profit or loss, and then topic 4, which was specifically dealt with investments in associates here. So I'm going to go a little bit slower on this question. Probably a good idea would be to watch this video at 1.25 or 1.5 speed. The income tax rate, we are told, is 40%. That's always good to know. The requirement is to make partial statements of comprehensive income for the years ended December 31st, 23 and 2004, and then statements of financial position for those year ends as well. So it's all in the name of Partridge. So I like setting up my answer first. So I'm going to be making a partial statement of comprehensive income, Partridge. And I kind of like to be able to compare how things were done for the 2 years. So I'm going to lay out the information next to each other. So 2003, and I'll show 2004 right next to it. And so now I'm going to have to rely on what I remember. So for fair value profit or loss, I know that dividends, transaction fees, um, realized or unrealized gains and losses, they all flow through the net income portion. And many companies, in order to be efficient with their reporting, will just collect all of those numbers into one account, one line called investment income from FVPL. So that's what I'm going to do for the statement of comprehensive income for purposes of for the year 2003, basically under other revenues and expenses. We will have a line for investment income from FVPL. In 2004, since the status changed to significant influence, we will be reporting investment income, but this time around from associates. And there is going to be a remeasurement on March 1st when significant influence was obtained. We will remeasure the shares to $30. The previous year-end price for Eagle Corp shares had been $27. So 27 to 30, we can see there's a remeasurement gain. So I'm going to have a line for gain on remeasurement, or gain on reclassification, if you like. Gain on reclassification. and we'll have a line for that. We calculate the amount, but we're going to have a line for that. So sometimes, it helps to have a big picture view here. What's really going to happen? Well, for 2003, we will be reporting the investment income from FVPL on March 1st when the reporting model changes from FVPL to the equity method. We are going to report a gain, a reclassification gain. And we know it's going to be a gain because on December 31st, 2003, the stock price was $27. And as of March 1st, the stock price is $30. So that's an increase. And we know that will result in a gain, $3 a share. And then subsequent to March 1st, we will be reporting the investment income from associates. We don't know the amounts per se, but we at least need to know what to expect. Likewise, we will be making comparative balance sheets, partial balance sheets, so statement of financial position. And it's not a bad idea to indicate it's a partial statement. It's not a full statement here. And it's at December 31st, not year ended. And so for 2003, the investment, since we were using fair value profit and loss model there, it would be reported as a current asset. So under current assets, there's more than one asset that a company might have, and we'll have FVPL investments. And once the investment is reclassed into the associates category, we will then move it to long-term investments. And we will call that investment in associates. And the name of the associate is Eagle. So I kind of laid out what my solution is going to be like. Now all I have to do is do some math to figure out the specific number. So we're going to start with 2003 calculations. So calculations. In 2003, remember, we were using fair value profit and loss model. So it's about how many shares did we have? Well, we had 8,000 shares. At the end of the year, the fair value per share was $27. So fair value, so year 2003, fair value at year end was 8,000 shares at $27. The investment must have been reported at $216,000. Now, the cost of the investment was, we had purchased this investment at $26.50. Or 212,000. The brokerage fees under fair value profit or loss, you must remember, is expense. So there was an unrealized gain of $4,000 for 2003. The brokerage commission was $8,000. That would be expensed. Brokerage commission expensed. It was $1,000. And the other thing that we'd have to take into account is the dividends. So on the 8,000 shares, we got a dividend of 75 cents a share on July 31st. Dividends, 8,000 shares, 75 cents per share. So all said and done, the investment income from fair value profit or loss investments was, for the year 2003, $4,000 of unrealized gain, take away $8,000 of the brokerage commission, and then add $6,000 for the dividends, we get a total of $2,000 investment income from fair value profit or loss. And that was it. We didn't care about the net income for Eagle Corp for the year 2003 because we weren't picking any portion of that. On March 1st, 2004, when Patridge acquired an additional 16,000 shares at a price of $30 a share to get significant influence, the existing 8,000 shares must be remeasured. So for 2004, year 2004, there will be a reclassification gain, right? So we have fair value at March 1st, year 4, the 8,000 shares have a fair value of $30 a pop now. And their carrying amount, book value, the last time we had done fair value adjustment was December 31st. The book value is $216. So we're looking at a reclassification gain of $24,000. Easier to follow it as the difference between the $27 and the $30. $3 increase in stock price, 8,000 shares, 8,000 times 3, that's our $24,000. This is our reclassification gain, 24,000. This reclassification gain is reported on the income statement for 2004. All right, so now what do we have? The investment in Eagle cost. What is the cost? Well, here's something to ponder. The 8,000 shares that we had owned from the past have converted into the investment in associate. They've been reclassified along with 16,000 additional shares. The total number of shares is now 8,000 plus 16,000, 24,000. The price per share is $30. The brokerage commission of $15,000 is capitalized. So we need to add the brokerage commission to the cost of the investment. We're looking at 24,000 shares at $30 plus $15,000 of the brokerage. 24,000 times 30 plus the 15,000. The cost of investment in Eagle is $735,000. That's a good thing to remember. To this, we will be adding investment income, which we haven't yet calculated, and then subtracting the dividends. So the dividends from Eagle will be on 24,000 shares. During 2004, Eagle paid a dividend of $1 per share. So $1 each, 24,000. Remember, dividends under the equity method reduce the investment account. They're not part of income. Once we figured out the investment income number, we would know what the investment in Eagle should be reported at for 2004. So investment in Eagle, what it should be on December 31st, 2004. We just don't know the amount yet. Now, what about the calculation? So Eagle's net income for the year 2004, we're told is $780,000, and it's earned evenly during the year. And that's a useful thing to know because Partridge only got significant influence on the 1st of March. Partridge is only going to be able to claim its share. We haven't calculated what Partridge's share is, which we should be doing in a second. Okay, how many shares does Eagle have? 100,000 shares. So if Partridge owns 24,000, that's 24%. Partridge will be picking up 24% of Eagle's net income as its own income, investment income. But for year 2004, that is only going to start from March 1st. For 2004, we need Eagle's net income from the period March to December. So $780,000 was for a full year. March through December is 10 months. We need to pick up Eagle's net income for 10 months. That's 650,000. Partridge will be picking up 24% of this number. And we have to look at additional information. On this date, Eagle Corp's net book value was $2.4 million. Its assets and liabilities had fair values equal to their book values, except for an unrecorded patent with a fair value of $120,000 and a remaining useful life estimated to be 4 years. All right, so this patent is a limited life asset. So this fair value difference, now keep in mind, if it was unrecorded, it means the book value was 0, fair value was 120. So this is an understatement. 120,000 divided by 4 will work out to $30,000 for a full year. We will be picking up 10 months worth. So fair value difference amortization. On the patent, we have 120,000 divided by 4 times 10 over 12. And we know that this amortization will reduce net income. So that's negative $25,000. And then the next thing to note is that there was an intercompany sale. There was a downstream sale of land. In May of 2004, Partridge sold land having a book value of 400,000 to Eagle for 600,000. That's a total profit of total gain of $200,000. Such gains are considered unrealized until the land is sold to an outside third party. There's nothing of that sort being indicated here. So we want to make an adjustment for intracompany. So unrealized downstream land gain, the amount of the gain. So the unrealized land gain before tax is $200,000, as we saw. The tax amount at 40% works out to $80,000. After taxes, the land gain, unrealized land gain, is $120,000. For the intercompany profits, they are deducted at after tax amounts. That's $120,000. Adding up Eagle's net income less the amortization for the patent and the unrealized downstream land gain, we get Eagle's adjusted net income, $505,000. And our friend Partridge owns 24% of that. So 24% of 505,000 gives us the investment income for the year, 121,200. This amount of investment income is added to the investment in Eagle, and we get the year-end value of $832,200. So what's reported on the statement of comprehensive income is the $832,200 for the investment account, and investment income for the year is reported at $121,200. So that was practice question 2.